General Electric, ticker GE, is currently trading live at $308.74. That's a solid move up of $4.87, representing a 1.60% gain just about half an hour after the opening bell here on October 27th. And right away, that $308 price tag is the first thing that confuses a lot of people. The common expectation, the narrative many investors are still holding on to, is that GE is this old-world broken-down conglomerate. They remember it as a symbol of American industry that fell from grace, drowning in debt from its finance arm, GE Capital, and becoming a penny stock pariah. They see a $308 stock price and assume it must be wildly overvalued, a bubble disconnected from fundamentals. But that expectation is completely out of date. The reality is that the company you are looking at, this GE, is not the General Electric of your parents' generation. It's not light bulbs, it's not kitchen appliances, it's not even the power turbine business anymore. As of this year, following the highly successful spin-offs of GE Healthcare and GE Vernova, the company trading under the GE ticker is now a pure-play global leader in aerospace and defense. This is GE Aerospace. That $308 price and this 32.62 KR market cap reflects a complete restructuring and a fundamental re-rating of this focused, high-margin business. This 1.6% pop today isn't happening in a vacuum. We're seeing broad strength across the aerospace and defense sector. The fortunes of GE Aerospace are now tied directly and transparently to two main things: airline flight hours and new aircraft deliveries. This is the company, through the CFM International joint venture with Safran, that produces the LEAP engine. That engine is the exclusive power plant for the Boeing 737 MAX and a primary option on the Airbus A320neo family. This is the classic razor and blade model. They might sell the new engines at a very slim margin or even a loss because they are locking in decades of high-margin aftermarket service, repair, and spare parts contracts. That services revenue is the recurring cash flow engine that sophisticated investors are actually buying. Today's buying pressure is likely a continuation of the market digesting this new, simpler structure. Institutional money is trying to find the right valuation. This methodical accumulation is also a result of index fund rebalancing. For years, GE's weight in major indices like the S&P 500 was shrinking. Now, as a focused aerospace and defense company, it's being recategorized. Portfolio managers who are mandated to hold A&D are now forced to buy the stock to match their benchmark, while generalist industrial funds that held the old conglomerate are selling. This creates a roiling but ultimately upward pressure as the stock finds its new, natural owners. We also have to consider the macroeconomic environment. The expectation is that high interest rates and high oil prices are bad for the economy and bad for industrial stocks. But for GE Aerospace, the reality is a net positive. When jet fuel is expensive, the economic case for an airline to retire an old, fuel-guzzling 737-800 and replace it with a new 737 MAX powered by GE's hyper-efficient LEAP engine becomes undeniable. The fuel savings alone can pay for the new plane. This macro pressure actually accelerates GE's order book, a dynamic many retail investors miss. The real tension point for GE isn't interest rates, it's the supply chain. Can GE and its partners ramp up production of complex components like single crystal turbine blades and composite fan casings fast enough to meet Boeing and Airbus's ambitious build rate targets? Any positive news on that front sends the stock higher. Now, because this is such a high-profile name with a complex history, it's always attracting attention from the short side. The expectation from bears is that this post-spin-off rally is overdone. The short thesis isn't that GE Aerospace is a bad company, it's that the valuation has gotten ahead of itself, pricing in decades of perfect execution. Shorts are betting that the supply chain constraints are far worse than management admits, and that the ramp-up in profitability from the services business will be slower than projected. They also point to the significant liabilities that remained with GE Aerospace post-spin, specifically the massive long-term care insurance obligations from the old GE Capital days. They argued this is a cleaner company, but it is not a clean one. How can you track this? It's essential to look beyond the price chart. You need to look at the data. You don't need a high-cost terminal. You can go directly to the NASDAQ website where they publish the official short interest data twice a month for every listed stock. You can then compare this to the stock's float, the number of shares available to trade. Right now, the short interest as a percentage of the float on GE is not critically high. It's not a meme stock squeeze candidate. It's more of a fundamental disagreement. But you should monitor the days to cover ratio. This metric tells you how many days of average trading volume it would take for all the shorts to buy back their borrowed shares. If that number starts climbing above 5 or 6, it means shorts are convicted, but it also builds the fuel for a potential squeeze if they're wrong. Also check your own trading platform. Many retail-focused brokers now show the cost to borrow, or borrow fee rate. This is an annualized interest rate. If it's 1 or 2%, that's normal. If you see it spike to 50 or 100%, it means the shorts are desperate and are paying a high price to maintain their position. We're not seeing alarm bells there yet. What's your take on this? Do you think the shorts are right about the valuation, or are they underestimating the power of the service's duopoly? The discussions on forums like Reddit are less about a coordinated squeeze and more about this fundamental valuation. Retail investors, by and large, are seen to be supportive of the Larry Culp-led turnaround, seeing the spin-offs as the final step in unlocking value. They are pushing back against the short thesis, pointing to the duopoly nature of the engine market. It's really just GE and Safran and Pratt & Whitney part of RTX. That kind of market power is a strong defense. For those who are just tuning into this new GE, let's clarify what this company actually does, because the $308 price makes no sense without this context. The expectation, as we said, is a messy conglomerate. The reality is GE Aerospace. This company designs, manufactures, and services engines for commercial aircraft. We're talking about the 787 Dreamliner, the GE NX engine, the 777X, the GE 9X, the most powerful engine in the world, the 737 MAX, the LEAP engine, and the Airbus A320neo family, also LEAP. But it also has a massive defense arm, building engines for critical military aircraft like the F-15EX, the F-16, the F-18 Super Hornet, and the Black Hawk helicopter. This defense revenue provides an excellent hedge against the cyclicality of the commercial airline business. It's a stable, high-margin foundation. The future is even more important. GE is developing the T901 engine for the Army's new helicopter fleet, a program that will last for decades. This is the crown jewel that was always hidden inside the old bloated conglomerate structure. The 1-for-8 reverse stock split in 2021 was the technical move to get the share price back up, but the real value creation came from the strategic decision to finally spin off GE Healthcare in early 2023 and GE Vernova, the power and renewables business, in April 2024. What's left, GE Aerospace, is the core. So where does it go from here? The expectation is for a simple, steady industrial climb. The reality is more complex and offers more potential. The primary catalyst is the global aviation recovery. Airlines are desperate for new, efficient planes. Travel demand, especially internationally, remains robust. As long as people are flying, GE services centers are printing cash. The second catalyst is the defense budget. With global tensions rising, demand for military hardware and the engines that power them is on an upswing. We're also watching for new technologies like their work on sustainable aviation fuels, SAFs, and the CFM RISE program, which aims to create a next-generation engine that's dramatically more efficient. This provides a long-term technology roadmap. The risks are just as clear. The first, as mentioned, is the supply chain. Any hiccup in sourcing critical forgings and castings stops the production line. The second is Boeing. GE is a supplier to Boeing. If Boeing's own production and quality control issues continue to limit 737 MAX deliveries, that directly reduces the number of new LEAP engines GE can deliver. It's a key dependency. The third risk is that legacy liability. The long-term care insurance policies from the old GE Capital portfolio are a black box. While GE set aside significant reserves, there's always a tail risk that those costs could spiral as policyholders age. This is the complex risk that the shorts are hanging their hats on. As an investor, you're monitoring these competing forces. You're watching flight hour data from airlines, production numbers from Boeing and Airbus, and GE's own quarterly reports. Comment below with your own position. Are you holding GE Aerospace as a long-term core position, or are you waiting for a pullback given the dependency on Boeing? This setup is the perfect example of expectation versus reality. The market's expectation is still catching up to the fact that GE is no longer a slow-moving, diversified mess. The reality is that this is a focused, high-margin aerospace leader. The $308 price reflects this new reality. The company's future is no longer about spreadsheets at GE Capital, it's about physics, metallurgy, and the relentless demand for global travel. In summary, the 1.6% move up to $308.74 this morning is part of this broader reevaluation. The old expectation of GE as a fallen giant is dead. The reality is a lean, focused aerospace business with a near-monopolistic position in a growing market. The tension is no longer about survival, it's about execution.